What's up, everybody? Welcome back to my channel, Mystery Money. As you can see, I'm outdoors. We've decided to go camping, but I wanted to make sure I put a video out. This is as raw as it gets. There's going to be minimal editing. Hopefully the content is still valuable to you. I hope you really enjoyed your Labor Day weekend, and hopefully, like us, it's still going on. Over the past several years, I've heard myths about the SBA program, usually from banks that do not do the loans, or they're trying to make themselves feel better by trashing the program. With all of the government money that's been handed out to small businesses through the SBA, there's been renewed interest in the programs. In this video, I want to debunk 5 of the myths that are out there that may have kept you from either applying for an SBA loan or even considering the program. Stick around for the end of the video for one more additional myth. I hope by the end of the video, you have a better understanding of how the program works and what benefits it can have for your business. If at any time you're getting value out of this video, if you could do me a favor and smash that like button, I really do appreciate it. And leave a comment with your thoughts on the SBA program. Now let's get into the video. So myth number 1, SBA loans are not borrower friendly. When compared to conventional loans, SBA loans are generally more flexible with regards to the equity requirements, collateral requirements. They will typically have longer repayment terms than you would for most conventional loans. Most conventional loans are going to have covenants or balloon payments to make the payment lower, but they do not have a true amortization for the payments. For example, a conventional loan may have a 10-year amortization with a balloon in 3 to 5 years. An SBA loan offers a 7 to 10-year term, and it's usually matching with no balloon. They can even provide up to a 25-year amortization if there is real estate involved in the transaction. In most cases, the standard interest rates charged under the SBA program are more favorable than a conventional loan at a non-SBA bank given the risk. Myth number 2. The lending process is slow and inefficient. SBA lending does require numerous documents, and that can be very tedious for borrowers when they don't work with a qualified lender who knows what they're doing. For the most part, the amount and type of documents and financial information required under the SBA are going to be very similar as a conventional loan. When you're considering an SBA loan, it's helpful to seek out a qualified professional or a preferred lender who knows what they're doing when they're working with the SBA. This type of lender will know how to determine your eligibility, exactly what documents you need the first time, and how to properly structure the loan for the loan terms and what are going to be acceptable with the SBA and the bank, and what appropriate documents that are needed to keep things moving smoothly. Preferred lender status allows the bank to approve the loan without waiting for the SBA's approval. So my gimbal actually died, which means I'm going to have to hold the phone for the rest of the video, but that's all right. A good lender will be able to walk you through the entire process, and in most circumstances, an SBA loan may not take any longer than a traditional loan. And that leads me to myth number 3. The SBA lends directly to borrowers. With the exception of the EIDL program, which I cover in other videos, the bank makes the loan, but the debt is partially guaranteed by the SBA. This allows the bank to provide credit to a borrower who may otherwise have difficulty obtaining a loan. The SBA acts like an insurance company, allowing the banks to extend beyond its conventional creditability. Other than the EIDL program, the SBA does not lend directly to businesses. Myth number 4. Any small business can receive a small business loan. The perception that the SBA is only for new businesses or struggling businesses or borrowers with bad credit is a myth. The SBA can be used to finance quite sophisticated businesses with high-end loan structures. The existence of an SBA guarantee does not substitute good underwriting. The bank still needs to go through all the proper processes to ensure that they're making a good loan. There are certain eligibility requirements with the SBA programs, and these are all prescribed by the SBA and apply to all lenders within the program, no matter what bank it is. Beyond those, a lender will apply their own judgment and standards when exploring the 5 C's of credit, which include your character, capital, conditions, collateral, and cash flow. A lender that knows your industry and the SBA knows exactly what components they need when it relates to your business. They're able to evaluate your entire financial picture and to structure the loan that best works for you. So myth number 5, SBA loan options require extensive collateral. When it comes to myths about the SBA, this is the most common that I see. The SBA program guidelines do require that lenders take certain available collateral, such as junior liens on real estate, when there's equity available. The program also specifically states that a borrower who lacks such collateral and is otherwise creditworthy should not be turned down due to the lack of collateral. A business with only 4 of the 5 C's and you're just lacking collateral coverage can still obtain the needed financing. For those with little or no real estate to pledge, it is important to find a lender who is skilled and is comfortable with relying on the financial conditions of your business. Lenders without an understanding of your industry will default to real estate. This is the mindset that you typically see with a small community bank when there's not really a strong understanding of cash flow. They're going to look for hard assets to take first. Find a lender who understands cash flow and the value of your business. Cash flow pays loans, collateral doesn't. So now on to the bonus myth, or number 6. SBA loans are more expensive than conventional loans. This is partially a myth because the fact that the SBA loans do have a fee associated with them as far as the origination makes it partially true. Recently, while the pandemic was disrupting businesses, the SBA waived those fees, and typically the SBA guarantee fee is 3% of the amount guaranteed. And I go over more of an explanation of these fees in this video here, so check that out. Even though you have to pay a fee, that fee is upfront, and you can most of the time roll that into your closing costs. You're still only putting 10% of the overall project in as equity. In a traditional loan, you'd be required to put at least 20% equity injection in. Let's do some simple math. If you wanted a loan for $100,000, you would need $20,000 down conventionally. With the SBA, you would need $10,000 down. So take the SBA fee of 3% or $3,000, and you're essentially ahead by $7,000. All the other costs associated with the loan, such as appraisals, environmentals, business evaluation, and others, can all be rolled into the loan. So there's less out of pocket. In a traditional loan, all of those costs would be along with the 20% down that you have to put in. Thanks for sticking with me to the end. I hope you enjoyed the beautiful scenery around. I hope I provided a better explanation of the myths involved with making an SBA loan. If you have any other questions or comments, make sure you post them below. Thanks again for taking time to watch the video, and until next time, have a great day.